Hey guys, my name is Max Convexity. Welcome back to my channel, The Covered Caller. Appreciate you guys being here today. I want to talk about earnings trades and I want to talk about double diagonals because those are my favorite kind of trades to talk about. Straddle, strangle, swaps, whatever. I call them different names, but they are my favorite trades to talk about. So I'll just share the entire screen this time. All right. Yeah, I cannot begin to tell you how much I love double diagonals. So the thing about a double diagonal is it's an income trade, but at the same time, it's long volatility, and that usually doesn't happen. I'm trying to think of something that is, I don't know. But these can also be made where they're long volatility. They're always long volatility, but the way I do them, they're also long the market. Well, they can also be made where they're short the market. This can be a bearish income trade. So an income trade means it's theta positive, which means it has the expectation of making an income. Also, what an income trade means in options, there's two kinds of trades. There's a trade or a strategy where you construct the strategy with the thought in mind of the market not making an outsized move. And that's this strategy. But there's other option strategies where you're trying to profit off an outsized move. Well, this strategy, it does monetize a no move. At the same time, it's not hurt by an outside move. Okay. And if it's an outside move up, I'll show you in a second. That's what I call the consolation prize. But typically income trades are short volatility, which means they get blown up or blown out by an outsized move in price or volatility. Think about it. Whenever your favorite high yield covered call fund puts on a position and the next day the market does, like what happened to Tesla, and then the market just blows through the strike and volatility goes up. Sometimes you wish, man, I wish they would have waited one more day to put on that position because it would have had a higher price. They would have been capped at a higher price. So, we see that all the time. An income trade, when you do an income trade, you have your fingers crossed that you don't get some volatility or a big move in price, because your typical income strategies are trying to monetize no move and are actually hurt by a move or a blow up in volatility. Okay, so Tesla. On July 11th, I did some content on a Tesla double diagonal, and we've been looking at it every day in the morning, and it's not doing very well. It's down $100 right now. With these types of trades, I scalp them. In other words, if the Tesla trade was profitable right now, I would take it off before earnings. Actually, Tesla's earnings are out now. Well, I'm sorry. No, the closing bell is not for 50 minutes. Okay. I thought the closing bell was now. What the heck? If I'm on, how could that even be? Oh my gosh. I guess I hit pause because I was doing another video and I couldn't find the other controls. So instead of hitting mute. All right. Well, Tesla's earnings are out now. All right. Or they should be out. They're coming out after the bell. They should be out soon. So in real life, we would have made this decision before. And like I said, this video I actually shot about 30 minutes ago. All right. So now let's look at option strat. Sorry, the screen's such a mess, but I just don't want to have to record this video a third time because I'm not showing something that I meant to show. All right, so option strat. All right, so the Tesla trade, well, like I said, we would have had to do something in real. It's showing down 116 bucks. All right, this trade again, just real quick, is short the 280 call and the 255 put that expires this week. And then it's long the 255 put and the 270 call that expire the next week. At expiration, it has a nice looking profit and loss graph where it could possibly be worth $500 if the price doesn't move. Now, of course, earnings are coming out. We know the price is going to move. But this trade had a buffer, or it still has a buffer. The market has to go down. Tesla has to go down another 4.1% between now and Friday for this trade to lose money. So So we'll see what happens. We can ride it all the way till like Thursday or Friday. But even if we can get it until Thursday and Tesla's price doesn't drop, if earnings come out and make Tesla's price drop, this one's not going to work out. But if we can ride this into Thursday, hopefully take this off for somewhere between, $300, $400, $500, $600, or if it's a big beat, even if it's a big beat, this should still be worth a little bit of money, 300 or something. So we'll see. This one's an interesting one to watch. So we're going to go to my account. Now, unfortunately, because I already shot this video once, I already have the Microsoft and Amazon trades done that I wanted to show you. But we'll just delete the trade really quick. And then, because I want to really show kind of a best practices on how to construct it from scratch in case people are trying to learn. I've done this. I've shown these videos several times, and I usually don't emphasize the strategic part of it. So let's go to option strat. So we need to do something on Amazon. So the first thing we need to do is find out when the first best practice is, hey, when is Amazon's earnings? And Amazon's earnings are after the close next Thursday. Okay. And Microsoft's earnings are after the close next Tuesday. So the next best practice is to construct a double diagonal, but to put the short week, this is one of the most important things. The short week has to expire in the same week the options earning announcements happen, because that's what makes this trade work. So I could have sworn I already did it. All right. Anyway, so I always I go to option strat. I start with build, then I go to double diagonal. All right. So then the first thing I check is the expiration date, and these are right, because the blue is when the short legs expire. You could see it says 8-2 and 8-2 down there in blue. They expire August 2nd, which is the week of earnings. Very important. The long leg can expire any week you want it to, but it has to at least be the week behind it to be a double diagonal. So I just always go the 1 week behind it, because that makes the trade a little bit more, it makes it a little cheaper. I don't like to spend a lot of money on these. I just like these are good trades to throw $300 or $400 at and try to make a quick couple $100. But I do it on 5 or 10 stocks at a time, and try to make. Hopefully, you want to hit one of them huge is what happens sometimes. Anyway, all right. First best practice is get the dates right. Okay. Next best practice is drag all the strikes right to the at the money. This is trading at 444.67. So I drug the put. There's the 4, it could be anything. That's a 445 put and a 445 call that you would be short if you did this. The put cost 11, the call cost 11. So you make about $22 on that. But then you would buy this call for $13 and this call for $12, and overall, the trade would cost you a $210 debit. That's also your max risk. This is not a bad trade for a pre-earnings trade. It has risk on the upside. If Microsoft beats earnings, it goes up 10%, you can lose. It'll be a max loss for this trade, though. Same thing if it goes down 10%. All right. I like to push earnings off to one side or earnings. I like to push the risk off to one side or the other. That's what I'm trying to show you guys. Options nowadays, or especially nowadays, that the bid-ask spreads are so tight and there's free commissions. You can do crazy trades like this that give you a huge advantage that you could have never done, before they make commissions free. Commissions free is a big part of this. But also all the liquidity too. Anyway, so here's the first thing I do. I go to the call leg, because I like to push all the risk off to the bearish side. So I go to the call leg and I move it up a strike. Then I move it up 2 strikes. Okay. You can see when I move it up 2 strikes and leave everything else the same, then all of a sudden you have no more upside risk. No matter how far Amazon goes up, it's not going to, it can't make you lose money. All right. I forgot to tell you this one thing. First best practice is see what a buffer you have. And the buffer is the percentage you can lose before it starts losing money. So it's in a downside buffer is what I'm talking about. This has a 4.9% downside buffer. If you move this call up here to the 450 strike, it take some of your buffer away. Now you just have a 3.5% buffer. And it also adds risk. The trade's total risk now is $447, where before it was $210, right? Wasn't it 210? Yeah. Okay. Well, anyway, so what I do is I visually like to do this until it makes a risk reward, a visual risk reward that looks appealing to me. So I'll show you what I'm looking for. So I'm looking for as big of a buffer as possible, but I'm also looking for a good consolation prize. A consolation prize is how much it'll make if it blows out all the strikes and just goes up, 20% or something. So the consolation prize on this is 250. The max risk is 550, but it has a gigantic buffer on it, or what I consider a gigantic buffer, 2.9% buffer before you start losing money. Anyway, this would be a decent trade. I could, let's just do this trade. I mean, this because I'm just trying to show you guys, it's very simple. All we're doing from a very basic double calendar, which, is just moving, it's just moving the strike around. We're doing financial engineering. When we move that strike, we're pushing the risk off to this other side. Let's say for some reason you're bearish on Microsoft. You take the put and you push the put more in the money. Same thing. All you have to do is push the put down 2 strikes, and then you don't have any downside risk. You'll make $60 no matter how low it goes. If that's not enough for you, you can push it down one more. Okay. Now you make $207. Let's see what the buffer is. The buffer is 3.5%. We forgot to check, or I forgot to check the initial buffer, the initial upside buffer, 6.1%. All right. So when you start jacking with these strikes and doing the financial engineering, of course, what you're sacrificing something. So you're making you're losing some of your buffer. Now your buffer is only 3.5%, but that's not a bad looking trade there. If you were bearish, it's still an income trade, but because it can go nowhere and make money. So it's an income trade, but it doesn't get hurt by a big down move. Anyway, what I generally always put the risk on the downside, especially when we're in a bullish market. Maybe when the market, like during 2022, you could do some of these and put the risk on the other side. That's kind of up to you. All right. So for this right here, let's see. All right. So what I also did, I moved the call that we're selling out to 455. That's still bringing in $6.90. But I moved the call that we're going to buy out a strike or two also, and it made a better combination of risk reward, in my opinion. Consolation price is $135, which is not bad for $400 worth of risk. I always want the consolation prize to at least be a 30%, 33% or whatever, at least be a third. And that's a third. That's close to a third. Let's do this. Let's move this out to 460. All right. We're costing ourselves buffer. Now we only have 2.5% buffer, but oh well. You only live once. $500 risk, 2.5% buffer. I say let's go for it. But also I want to remind everyone it's long volatility. So let's do a hypothetical. Let's say we come into, who is this? Microsoft. Their earnings are Tuesday after the bell. So let's say we come up right to their Tuesday after the bell, or there it is, Tuesday after the bell, or Tuesday before the bell. This is before it rings, so they haven't announced earnings yet. What I'll do with this trade is if it has any kind of profit, I'll just take it off. That way I don't have to, if it's worth $100, take it off. That way I don't have to subject myself to the binary risk of the earnings announcement. Okay. But if you can see here, by the time that much time has passed, there's a chance it has a pretty nice little payoff in it, depending on what the price does. If the price goes, let's say the price drops between now and then, and you're down $300 in this thing, but earnings announcement hasn't come out. In that case, I would just hang on to it. Most you can lose is 500, but there's always a chance they'll blow out earnings and you'll get back on the positive side of the ledger. So this is a scalp trade. If I can take it off before earnings, I will. And then if I have to, I'll leave it on. It's what they call a scalp. You could also do this with with, 2 lots or 20 lots. You could do 20, 20 lots and then take off 10 before earnings, hopefully for a little profit, and then let the other 10 ride into after earnings. But anyway, I think it's better if it has a loss like Tesla does, let's just let it ride and see what happens. Now, Tesla's earnings should be out pretty soon. I was hoping to see it while we're on TV. Anyway, all right. So I will definitely post this one. I'm going to, let's see, Microsoft earnings. Wow, earnings. Gosh darn it. I'll post a link to that if you guys are interested. Now, I appreciate if you're still with me. Let's do this Amazon one super quick. All right, because these don't have to be that hard. So you get to Option Strat, you type in Amazon, and then you have to go build double diagonal. Or I don't know if you have to. This is the way I do it. Drag the strike prices in, and then check your buffer. This gives you a base. This is the most yield. This is the, this is a base of where to start with. So you have downside buffer of 8.6% and upside buffer of 9%. So if you guys are into neutral trades, a person could do this. There's nothing wrong with that. All right, but I'm not showing you how to do the neutral trade part of it. So what we're going to do, assuming we're bullish, the first thing we're going to do is check that the expiration dates are in the right week. We need the shorts to be in the week that they expire. So that, like I say, the short legs are underneath the line here. So okay, if we're bearish, we would do this. And we could push the risk off to the bullish side. We would start with something like that. And then we could also move the put we're buying, just like I did in the other one, move it around and make some risk and reward that you could be happy with. Okay, we aren't bearish though. So we'll do it like this. Okay, so that's not enough of a consolation prize. $150 on, yeah, that's actually pretty good. 50% on a consolation prize and still have 5% buffer. I say let's just do that one. I'm not to jack with it too much. I mean, that one looks as a fine looking trade. Now, and then of course we'll keep paper trading these, and every morning we'll look and see how they're doing. I'm going to do the Apple one in real life. I really like the risk reward in the Apple one. I don't know if I showed you guys that one yet. We'll look really quick. All right. And the game plan is just the same as the last one. We'll go to, here's where it should be after the bell next Thursday. And that's assuming we don't get a bump and vol. It could even be better if we get a bump and vol. But that's where the profit and loss graph should be. So as long as this thing hasn't dropped more than like 4%, you take this off for $100. Even if it dropped 4%, market doesn't move, take it off for $390. Amazon was blowing up this morning, but anyway, it was going up. Market moves up a little bit, 3 or 4. Anyway, if you get a chance to take it off before the earnings announcement, you don't have to subject yourself to the binary risk that maybe it's bad and it goes the other way. That's exactly what we're going to do. But if it's down here, we'll just leave it be and let it ride out and see what happens. Okay, so now let's see what we have now. This is the way I do it in real life. Usually I'll pick out 4 or 5 that I like and try to risk 400 or 500 on 4 or 5 of them, a couple thousand, and try to make $1,000, in a week. Okay, so let's do this. Let's look. So I did some off screen. Well, one of these Microsoft ones was the one I meant to erase. We'll just erase this one. Okay, I was just going to show you, I did an Apple one off screen, but I really like the risk reward on this one. Apple super liquid. Look how liquid these options are. Well, this one is, and this bid at 245 bid at 215 asked at 245. Okay, well, typically they're real liquid. This one has a 10-cent spread. This 230 call has a 20-cent spread, and this one has a 30-cent spread. Okay, well, anyway, I like the risk reward on this one. This one has a couple $100 risk, which isn't very much. Consolation prize is about a third of that, $71. That's kind of the best practice. What you're really playing for is the same thing. Apple's earnings aren't until next Tuesday, right? So we'll take it off right here. Hopefully take it off for 50, 100, 150, 200 bucks, something like that. See what happens. If not, we'll leave it on until after earnings and then hope that it finishes somewhere above 219. Anyway, we'll keep an eye on these next week as the days go by. We'll look at the profit and loss. I'll share the link for the Amazon and Microsoft ones. So whenever you do something after the bell, it just gives you the closing prices. Obviously, it's too late today to make this trade. Tomorrow, you can maybe make the same trade and even get a little better price or a little worse price. But anyway, this will give you a place to start because you can open it up in option strat. And now that you know how to do it, you can move the strikes around and try to engineer the outcome where it matches your needs for the amount of risk and reward that you're able and willing to take on. All right, guys. I really appreciate you guys being here. I love questions about options. If you guys have any questions, absolutely hit me up and tell me how you do earnings trades if we haven't already talked about it. This isn't the only way to do it. In fact, there's a jillion ways to do it, and there's probably even better ways to do this. This is suitable for me. I always talk about suitability. Investments need to be suitable for you, or that's what they teach you when you're a broker. That's what they teach. You have to know the customer, and you have to sell them suitable stuff, or else you can get kicked out of the business. Well, anyway, when you're your own broker, stuff like this, you need to find suitable investments. For me, this is a suitable, fun way to YOLO earnings trades. Okay. Like I say, let me know what you guys think, and you guys have a great day.